Good morning. Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. We're coming to you from the Nasdaq PHLX options trading floor, as we do for each quadruple witching expiration. Joining me, as he always does, we have Shawn Cruz. He is the manager of trader strategy over at TD Ameritrade. I cannot believe this is the last time we are here for 2018. What a year it has been. Before we get into some of the news headlines that were fast and furious this week, let's have a quick market update. Looks like all sectors are in the green at the open.
And you know what, I think it makes sense. You've just seen no love for equity markets. Yesterday was just a full-on rout where everyone seemed like was selling everything across the board. We got some positive results out of Nike last night, and I think there is starting to be a little bit of a rotation back into risk assets, which is something we really haven't seen all week long. I think it'll be interesting to see how this plays out throughout the day, though.
Yeah, it will be interesting because Santa Claus has certainly not come to the equity markets for December, that's for sure. Let's review the news of the week. The news this week could have filled up an entire year, and it certainly has markets shaking, and for good reason. We'll start off with the Fed hike first on Wednesday. I was a little bit surprised by the reaction. This was a telegraphed move. The comments after were more dovish. That's what the market was looking for. It did not digest it well.
And I was expecting the Fed to start hinting at maybe 2 rate hikes in 2019 instead of the 3 that seemed to be priced in. I expected the markets to react more positively to that.
Right.
The one thing that stood out to me out of that Fed meeting was that they did hint at some point they may go above that natural rate of interest, which is actually a little more restrictive on the monetary policy front. I think that's something that markets looked at, and they also dialed back their expectations for growth in 2019 from 2.5% to 2.3%. So I think you put that next to a lot of the leverage we're seeing in some of these companies. I think interest rate risk is going to be something to look at in 2019. I think right now the Fed's signaling that it's still going to be a little bit more, I'd say, aggressive with their monetary policy, at least for 2019 and 2020 as of now, was something that gave markets a pause.
Well, that's something that we spoke about in September when we were here for Q3. You had mentioned that explicitly, that interest rate risk is an issue because you have that liquidity vacuum, and that seems to be the environment that we're in right now. Granted, we're coming into the holidays, but I think you made an excellent point back there in Q3.
We talked about that. A lot of traders right now have not traded in a non-QE environment where the Fed is providing so much liquidity. It helps dampen some of the moves that you see in markets. It can make these swings, I'd say, a lot less abrupt, a lot less, I'd say, almost violent in some cases.
Right.
But I think right now what you're seeing is the Fed is not there to step in and provide liquidity at all times. And if you're a trader, it really has to change your outlook. And I think we are seeing that. We're not seeing this buy the dip mentality as much as we used to. And I think that is keeping buyers from wanting to get in there and step up. And then certainly knowing there's about, we'll call it a week and a half of just holiday lack of
I mean, you have a half
volume.
day on Monday, off on Tuesday. Traders are basically checked out for the week.
Yes.
Of course, we will be working, but it's going to be a difficult environment to trade through. And of course, we have quadruple witching expiration, although I think most of that has already played out on Wednesday and Thursday. Let's talk about the government shutdown, because this is a game of chicken right now. Either side is not backing down, and Trump put out a tweet this morning that if we shut down the government, it's going to be prolonged. Markets, I'm surprised they're actually up on the open with comments like that.
I think markets started pricing that in earlier on in the week. I think a lot of that really came to the forefront yesterday, especially, and that may have contributed just to some of the strong selling pressure that we saw and the lack of buyers wanting to step up. Was they really were pricing in a lot. One, there was the post-Fed reaction, which I think was getting priced in, continued concerns on the geopolitical front, and then the threat of this government shutdown, not being like the government shutdowns we've seen in the past, where they shut it down and then a week later, before it takes a while for the government shutdowns to really play out in the numbers. I think the administration come out and say this one may be a little bit more prolonged is something that made markets focus in on this and really assign a lot more, I'd say, risk to this than we have seen in past shutdowns. I think that's why you're seeing that violent reaction yesterday. But I think right now you're seeing some buyers come back in. I wouldn't want to say we're in the clear just yet, especially if you look at the VIX, still up at 27 or 28. Once we broke through that 25, 26 level, I was actually interested to see where we would cap out. Looks like 28's there for now, but until you see a meaningful pullback in the VIX, I wouldn't really look at any sort of rally as sustainable.
I mean, it's going to come into question at some point, and we've heard a little bit about this throughout the week, where value managers have to be looking for some amazing deals right now. I mean, you know, you had the Nasdaq composite in correction territory yesterday. Indices are down double digits for the year. That narrative is going to start to play out at some point as well. But then we also have trade wars that we're talking about this week as well.
I think one, if you look at what we're seeing in the markets and we're seeing a lot of this volatility, if you are a trader, and we see this at TD Ameritrade, our trader clients actually see a lot of opportunity with these back and forth movements. Our derivative trading as a percentage of overall volume usually goes from low 30%. We've seen it move up to 35%. If you're a long-term investor, and I think that's where you're getting at with a lot more of these value plays, you're starting to maybe see some buying opportunities in names that you have been watching. Just keeping in mind what your time horizon is. I think right now, if you're an investor or a trader, you're really asking yourself, what's my time horizon? And that'll dictate where you see opportunity in the market right now.
And then the other thing we're contending with this week as well, unraveling of geopolitics. It felt like the velocity was pretty strong this week.
Yes.
General Mattis resigning yesterday, and there's that power vacuum, and not only the U.S. providing leadership globally, where are we going to get that? And I mean, you're seeing it across not just an equity market, but multiple markets that are reflecting that.
I think so. I think right now markets are really trying to find there's so many risks right now on the geopolitical front that they're trying to price in, and they're really trying to get a feel for how to price these in as these things are developing. And right now, I think there's still a lot of uncertainty. General Mattis hinted that said he would stay on until February 28th while they find a replacement and can assure some sort of a smooth transition. But I still think markets are really trying to figure out what this means. I think General Mattis was a very stabilizing force in the administration. So I think his departure is definitely going to make some people review their political risk and how things are going to play out for 2019 on that front. And that is getting added to just a number of other risks that they were already trying to figure out.
Yeah, there's a lot of uncertainty. We don't have a chief of staff or a secretary of defense, but we'll see how that plays out. Let's go back to volatility and volume during a holiday week. I'm sure a lot of traders, there's fatigue out there.
Yes.
24/7 news cycle certainly is fatiguing. There could also be some really good opportunities, though, on a quiet week like this if you're on the desk.
There are. I think right now, if you're sitting there and you are watching your screen, looking for opportunity is something where maybe you can get a little positioning in, because I do have a strong feeling that once we get into that first week of January, you see a lot of traders and a lot of these big firms coming back from being out on vacation. They start looking ahead to 2019. They start wanting to position their portfolios or their books. I think if you're a trader and you want to start to maybe get ahead of that, there is the ability to do that. I would just caution that. Keep in mind there will be low volume, so if you do get into a position, you may have difficulty getting out at the turn of a dime. If there is some sort of a major swing in the market, there's just going to be a lot of, I'd say, low volume and illiquidity that you need to be on the lookout for the next week or two.
All right, Shawn, thank you so much for joining us, and catch us in the 10:30 hour. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.